Question 1. Comparative studies suggest that benchmarking is a critical tool for employers to assess the competitiveness of their group benefit plans. A Group Benefits Associate, GBA, is tasked with providing a client with insights into how their current benefits package compares to similar organizations. The GBA has access to a database of benefit plan information from various employers. Considering the regulatory framework for group benefits in the relevant jurisdiction, which of the following approaches to benchmarking would be most appropriate and compliant? Option A. Utilizing aggregated and anonymized data from the database that reflects industry-wide trends and average costs for comparable benefit provisions, ensuring no individual employer can be identified. Option B. Relying on anecdotal information and informal discussions with other benefits professionals about their employers' benefit offerings to gauge market competitiveness. Option C. Directly comparing the client's plan details with those of a few specific, named employers from the database that are known to be direct competitors, without obtaining their explicit consent for such a comparison. Option D. Presenting the client with raw, unaggregated data from the database, including specific plan features and costs of other employers, to provide the most granular comparison possible. The correct answer is A. Utilizing aggregated and anonymized data from the database that reflects industry-wide trends and average costs for comparable benefit provisions, ensuring no individual employer can be identified. Explanation: this scenario is professionally challenging because it requires the Group Benefits Associate, GBA, to navigate the complex landscape of benchmarking data while adhering to strict regulatory requirements and ethical obligations. The GBA must ensure that the benchmarking process is conducted in a manner that is both informative for the client and compliant with the governing regulations, preventing any misrepresentation or misuse of sensitive data. The core challenge lies in balancing the desire for competitive insights with the imperative of data privacy and regulatory adherence. The correct approach involves utilizing benchmarking data that has been aggregated and anonymized in accordance with the specific regulatory framework governing group benefits in the relevant jurisdiction. This approach is correct because it upholds the principles of data privacy and confidentiality, which are paramount in the group benefits industry. Specifically, regulations often mandate that any comparative data used for benchmarking must not allow for the identification of individual employers or their specific benefit plan details. By focusing on aggregated trends and anonymized data, the GBA ensures compliance with privacy laws and maintains the trust of clients and participating employers. This method provides valuable insights into market competitiveness without compromising sensitive information. An incorrect approach would be to use raw, identifiable data from other employers without their explicit consent. This failure directly contravenes data protection regulations, which strictly prohibit the unauthorized disclosure or use of personal or proprietary information. Such an action would expose the GBA and their firm to significant legal penalties and reputational damage. Another incorrect approach would be to rely on benchmarking data that is not representative of the client's industry or size, even if anonymized. This would lead to misleading comparisons and potentially poor strategic decisions for the client, failing the GBA's duty of care and professional responsibility to provide relevant and actionable advice. While not a direct regulatory violation in terms of data privacy, it represents a significant ethical and professional failing. The professional decision-making process for similar situations should involve a thorough understanding of the applicable regulatory framework, including data privacy laws and industry-specific guidelines. The GBA must prioritize data integrity and client confidentiality. When seeking benchmarking data, they should always inquire about the source, methodology, and level of aggregation and anonymization. If there is any doubt about the compliance or relevance of the data, it is imperative to seek clarification or alternative sources that meet the required standards. A proactive approach to understanding and adhering to regulations, coupled with a commitment to providing accurate and relevant insights, is essential for ethical and effective practice. Question 2. The monitoring system demonstrates that a participant's claim for an accelerated death benefit has been submitted, citing a diagnosis of a terminal illness. The GBA's initial review indicates that the participant's life expectancy is estimated to be less than 12 months, which aligns with the policy's definition of a terminal illness. However, the submitted physician certification is somewhat vague regarding the prognosis and the specific treatment plan. What is the most appropriate next step for the GBA to ensure compliance with policy terms and regulatory requirements? Option A. Approve the claim immediately based on the initial physician certification, as the life expectancy estimate meets the policy's threshold for a terminal illness. Option B. Forward the claim to the plan sponsor for their decision, as the GBA is not authorized to make final determinations on accelerated death benefit claims. Option C. Request a more detailed physician certification that clarifies the prognosis and outlines the specific treatment plan, while also confirming the participants' understanding of the implications of accelerating their death benefit. Option D. Deny the claim due to the vagueness of the physician's certification, advising the participant to resubmit with more comprehensive documentation. The correct answer is C. Request a more detailed physician certification that clarifies the prognosis and outlines the specific treatment plan, while also confirming the participants' understanding of the implications of accelerating their death benefit. Explanation: the monitoring system demonstrates a potential issue with the administration of living benefits, specifically accelerated death benefits, ADB. This scenario is professionally challenging because it requires a group benefits associate, GBA, to navigate complex policy provisions, regulatory requirements, and ethical considerations to ensure accurate and timely benefit payouts while protecting the plan sponsor and participants. The GBA must exercise careful judgment to interpret policy terms, assess eligibility, and communicate effectively with all parties involved. The correct approach involves a thorough review of the specific policy language governing accelerated death benefits and the claimant's medical documentation against the defined triggers for benefit acceleration. This requires understanding the regulatory framework governing group benefits, which in the U.S. typically involves state insurance laws and potentially ERISA if the plan is qualified. The GBA must ensure that the policy's definition of a terminal illness or qualifying chronic illness is met, and that all required documentation, such as physician certifications, is complete and accurate. This approach upholds the ethical duty to act in the best interest of the plan participants by facilitating access to benefits when legitimately due, while also adhering to the contractual obligations of the policy and regulatory mandates for claims processing. An incorrect approach would be to deny the claim solely based on a preliminary assessment, without a comprehensive review of the policy and supporting medical evidence. This failure to conduct a thorough investigation violates the GBA's duty to process claims fairly and accurately. It could lead to a breach of contract and potential regulatory penalties for improper claims handling. Another incorrect approach would be to approve the claim without verifying that all policy conditions and regulatory requirements are met. This could result in an improper payout, exposing the plan sponsor to financial loss and potentially violating fiduciary duties. It also undermines the integrity of the benefits program. A third incorrect approach would be to delay the decision indefinitely without communicating with the claimant or the plan sponsor. This lack of communication and timely action can cause significant financial and emotional distress to the participant and their family, and may also violate regulatory requirements for prompt claims handling. Professionals should approach such situations by first understanding the specific policy terms and applicable regulations. They should then gather all necessary information, conduct a diligent review, and make a decision based on the evidence and policy provisions. Clear and timely communication with all stakeholders is paramount throughout the process. If there is ambiguity, seeking clarification from the plan sponsor or insurer is essential. Question 3. Investigation of a client's proposed life insurance policy reveals it has a significant cash surrender value component that grows over time, in addition to a substantial death benefit. The client is seeking advice on the tax implications of this policy, particularly concerning the death benefit and any potential policy loans. Based on the Income Tax Act, Canada, what is the most crucial consideration for a group benefits associate when advising this client to ensure tax efficiency and compliance? Option A. Advising the client that any loans taken against the policy's cash surrender value are always tax-free and do not impact the death benefit. Option B. Determining if the policy qualifies as an exempt policy under the Income Tax Act, Canada, and understanding the tax treatment of policy loans in relation to cash value accumulation. Option C. Confirming the death benefit amount and advising the client that all death benefits are tax-exempt under Canadian law, regardless of policy structure. Option D. Focusing solely on the insurance coverage provided by the policy and the ease of beneficiary designation, as tax implications are secondary to protection. Correct answer is B. Determining if the policy qualifies as an exempt policy under the Income Tax Act, Canada, and understanding the tax treatment of policy loans in relation to cash value accumulation. Explanation. This scenario is professionally challenging because it requires the group benefits associate to navigate the complex interplay between life insurance policy design and Canadian tax legislation, specifically the Income Tax Act, Canada. The associate must understand how different policy features can impact the tax treatment of death benefits and policy loans for both the policyholder and the beneficiaries, ensuring compliance and providing accurate advice to the client. The core challenge lies in identifying the tax implications of a policy that may be structured to offer both insurance coverage and investment growth, and how these elements are treated under Canadian tax law. The correct approach involves a thorough understanding of the Income Tax Act, Canada, as it pertains to life insurance. This includes recognizing that death benefits paid to beneficiaries are generally tax-exempt in Canada. However, the tax treatment of policy loans and the potential for the policy to be classified as an exempt policy versus a non-exempt policy are critical. A non-exempt policy, particularly one with significant cash surrender, value accumulation relative to the death benefit, can have adverse tax consequences, such as the taxation of gains upon surrender or maturity, and the potential for policy loans to be considered taxable income if not properly structured. The associate must advise the client on how to structure the policy to maximize tax efficiency while meeting their insurance needs, focusing on the tax-exempt nature of the death benefit and the rules surrounding policy loans and cash value growth. An incorrect approach would be to assume all death benefits are automatically tax-exempt without considering the policy structure and the potential for it to be deemed a non-exempt policy. This oversight could lead to the client facing unexpected tax liabilities on policy gains or loans. Another incorrect approach would be to focus solely on the insurance coverage aspect and neglect the investment component and its tax implications, or to provide advice based on general insurance principles without specific reference to the Income Tax Act, Canada. Misinterpreting the tax treatment of policy loans, such as assuming they are always tax-free borrowings, is also a significant error. Professionals should approach such situations by first identifying the relevant jurisdiction's tax laws, in this case, the Income Tax Act, Canada. They should then analyze the specific features of the proposed or existing life insurance policy, paying close attention to the death benefit, cash surrender value, and any loan provisions. Consulting with tax professionals or referring to official tax guidance from the Canada Revenue Agency, CRA, is crucial for complex situations. The decision-making process should prioritize client education, transparency about potential tax implications, and adherence to all applicable tax legislation to ensure the client's financial well-being and compliance. Question 4. The performance metrics show a slight increase in employee inquiries regarding benefit continuation post-termination. A departing employee, MS, Anya Sharma, has just provided her notice. As the group benefits associate, what is the most appropriate action to ensure compliance with portability and conversion rights regulations? Option A. Inform MS Sharma that information regarding benefit continuation is available on the company's internal HR portal and provide her with the login credentials. Option B. Assume MS Sharma is aware of her rights and wait for her to initiate further inquiries about benefit continuation. Option C. Verbally explain MS Sharma's general options for continuing coverage and advise her to contact the plan administrator for further details. Option D. Provide MS Sharma with a comprehensive written document detailing her specific portability and conversion options, including eligibility criteria, timelines, and associated costs, and offer to answer any immediate questions. The correct answer is D. Provide MS Sharma with a comprehensive written document detailing her specific portability and conversion options, including eligibility criteria, timelines, and associated costs, and offer to answer any immediate questions. Explanation. This scenario presents a common challenge for group benefits associates, ensuring departing employees understand their rights regarding continued coverage. The professional challenge lies in accurately and comprehensively communicating complex portability and conversion rights, which are governed by specific regulations. Failure to do so can lead to significant financial and legal repercussions for both the employer and the associate, as well as detrimental outcomes for the employee. The associate must navigate these regulations to provide clear, actionable information. The correct approach involves proactively providing the departing employee with detailed, written information about their portability and conversion options, including timelines, costs, and eligibility requirements, as mandated by relevant legislation. This ensures the employee can make an informed decision about maintaining coverage. This approach is ethically sound and legally compliant, as it fulfills the associate's duty of care and adheres to regulatory requirements designed to protect employee benefits. An incorrect approach would be to provide only a verbal overview of the options. This is problematic because verbal communication is prone to misinterpretation and is difficult to prove. It fails to meet the regulatory requirement for providing clear, written documentation of these rights, leaving the employee vulnerable to missing critical deadlines or misunderstanding the terms of coverage. Another incorrect approach is to direct the employee to a generic company website or a third-party administrator's portal without specific guidance or personalized information. While these resources may contain relevant data, they do not constitute the direct, tailored communication required by regulations. The associate has a responsibility to ensure the employee receives specific information pertinent to their situation, not just a general pointer to information. A further incorrect approach is to assume the employee is aware of their rights and not offer any information proactively. This passive stance is a significant ethical and regulatory failure. Regulations are in place precisely because employees may not be aware of their options, and the associate's role is to bridge this knowledge gap and facilitate informed decision-making. The professional decision-making process for similar situations should involve a thorough understanding of all applicable laws and plan provisions related to portability and conversion. Associates should always prioritize providing clear written documentation to departing employees, ensuring all critical details, deadlines, and contact information are included. When in doubt, seeking clarification from legal counsel or compliance departments is paramount to avoid misrepresentation and ensure regulatory adherence. Question 5. The efficiency study reveals that a significant number of claims for diagnostic imaging services are being processed with delays, leading to member dissatisfaction. The GBA is tasked with identifying the root cause and proposing solutions, focusing on the clarity of covered services definitions for outpatient diagnostic procedures. The GBA needs to determine the most appropriate method for assessing whether these specific imaging services are covered under the group benefits plan, adhering strictly to the regulatory framework of the specified jurisdiction. Option A. Rely on the historical claims processing patterns for similar imaging services, assuming that past approvals indicate current coverage. Option B. Consult with the imaging provider's billing department to understand their interpretation of what constitutes a covered outpatient service. Option C. Review the plan summary plan description, SPD, and the relevant statutory or regulatory definitions for outpatient diagnostic imaging services to confirm if the service meets the plan's coverage criteria and legal requirements. Option D. Assume that any diagnostic imaging service ordered by a physician is automatically covered as an outpatient service, provided it is billed with a valid diagnosis code. The correct answer is C. Review the plan summary plan description, SPD, and the relevant statutory or regulatory definitions for outpatient diagnostic imaging services to confirm if the service meets the plan's coverage criteria and legal requirements. Explanation. This scenario presents a professional challenge because it requires a group benefits associate, GBA, to interpret and apply complex regulatory requirements regarding covered services within a specific jurisdiction, balancing the needs of plan members with the financial sustainability of the benefit plan. The GBA must ensure that the plan's administration aligns with legal mandates and ethical obligations to provide accurate information and fair treatment to all participants. Careful judgment is required to avoid misinterpretations that could lead to coverage denials, financial hardship for members, or regulatory noncompliance. The correct approach involves a thorough review of the specific plan documents and the governing regulatory framework for the relevant jurisdiction to determine the precise definitions and limitations of inpatient, outpatient, and physician services. This approach is correct because it prioritizes adherence to the established legal and contractual obligations. By consulting the plan's summary plan description, SPD, and relevant statutes or regulation, the GBA can accurately assess whether a service is covered, ensuring that plan members receive benefits as outlined and that the plan operates within legal boundaries. This upholds the fiduciary duty to administer the plan fairly and in accordance with its terms and applicable laws. An incorrect approach would be to make assumptions about coverage based on common industry practices or the perceived intent of the plan, without direct reference to the governing documents and regulations. This is a regulatory failure because it bypasses the legally mandated definitions and criteria for covered services, potentially leading to incorrect coverage decisions. Another incorrect approach would be to rely solely on the provider's billing code or diagnosis without verifying if the service itself, as defined by the plan and regulations, is a covered benefit. This is an ethical and regulatory failure, as it abdicates the responsibility of the plan administrator to ensure that payments are made only for services that meet the plan's coverage criteria, potentially leading to improper payments or denials. A further incorrect approach would be to deny coverage based on a broad interpretation of medical necessity, without a clear, documented process and specific criteria outlined in the plan or regulations, which could lead to arbitrary denials and violate the principle of fair claims adjudication. A professional decision-making process for similar situations should involve a systematic approach. First, clearly identify the service in question and the plan member's request. Second, consult the plan's SPD and any relevant policy documents to understand the stated coverage for that type of service. Third, cross-reference these with the specific regulatory framework of the governing jurisdiction to ensure compliance with all legal requirements and definitions. Fourth, if ambiguity exists, seek clarification from legal counsel or the plan sponsor. Finally, document the decision-making process and the rationale for the coverage determination. Question 6. The review process indicates that a plan member has contacted a group benefits associate seeking clarification on a specific clause within their group disability insurance policy regarding the definition of own occupation. The member is experiencing a partial disability and believes they may qualify for benefits under this definition, but they are unsure how the insurer will interpret their current work duties in relation to the policy's wording. The associate has reviewed the policy document and recognizes that the definition is complex and has been subject to various interpretations in similar cases. Which of the following approaches should the group benefits associate take to address this plan member's inquiry? Option A. Inform the plan member that the definition of own occupation is too ambiguous to provide any guidance and suggest they seek legal counsel to understand their rights. Option B. Provide the plan member with a detailed explanation of the own occupation definition as stated in the policy document, clearly outlining the criteria and limitations, and advise them to consult with the insurance carrier directly for a definitive interpretation specific to their situation, while also suggesting they review the policy's appeals process if they disagree with the carrier's decision. Option C. Offer a personal interpretation of the own occupation definition based on past experience with similar claims, assuring the member that their current work duties likely fall within the definition, and encouraging them to submit their claim immediately. Option D. Advise the plan member to contact their direct supervisor to determine how their current work duties align with the policy's definition of own occupation, as the supervisor would have the best understanding of their role. The correct answer is B. Provide the plan member with a detailed explanation of the own occupation definition as stated in the policy document, clearly outlining the criteria and limitations, and advise them to consult with the insurance carrier directly for a definitive interpretation specific to their situation, while also suggesting they review the policy's appeals process if they disagree with the carrier's decision. Explanation. This scenario presents a common challenge for group benefits associates, balancing the need to provide accurate and timely information to plan members with the regulatory requirements and the limitations of their role. The core of the challenge lies in interpreting complex plan provisions and communicating them effectively without overstepping professional boundaries or providing advice that could be misconstrued as financial or legal counsel. Careful judgment is required to ensure that all communications are compliant, accurate, and serve the best interests of the plan members within the established framework. The correct approach involves a thorough review of the plan documents and relevant legislation, followed by a clear and concise explanation of the plan provisions as written, without offering personal interpretations or opinions. This approach is correct because it adheres strictly to the principle of providing factual information based on the governing plan documents and applicable regulations. It avoids offering advice that could be construed as legal or financial counsel, which is outside the scope of a group benefits associate's responsibilities and could lead to liability for both the associate and the plan sponsor. By directing the member to the appropriate resources for further clarification, the associate ensures the member receives comprehensive and accurate guidance from qualified sources. An incorrect approach would be to provide a definitive interpretation of the plan provision based on personal experience or assumptions. This is a regulatory and ethical failure because it risks misinterpreting the plan's intent or legal standing, potentially leading to incorrect decisions by the plan member. It also constitutes practicing without a license if the interpretation borders on legal or financial advice. Another incorrect approach would be to dismiss the member's query without providing any assistance or direction. This is an ethical failure as it demonstrates a lack of diligence and customer service, failing to uphold the associate's responsibility to assist plan members in understanding their benefits. Furthermore, it could violate service-level agreements or internal policies regarding member support. A third incorrect approach would be to suggest the member contact a specific external advisor without a clear referral process or disclaimer. This could create an appearance of endorsement or recommendation, potentially leading to liability if the referred advisor provides unsatisfactory service. Professionals should adopt a decision-making framework that prioritizes accuracy, compliance, and ethical conduct. This involves 1. Understanding the scope of their role and responsibilities. 2. Thoroughly reviewing all relevant documentation, plan documents, legislation, policy guidelines. 3. Communicating information factually and objectively, avoiding personal opinions or interpretations. 4. Identifying when a query falls outside their expertise or scope, and knowing how to appropriately refer the member to the correct resources, e.g., plan administrator, legal counsel, financial advisor, HR department with clear disclaimers. 5. Documenting all interactions and advice provided. Question 7. Market research demonstrates that claimants often struggle to understand the nuances of their long-term disability, limited benefits. A claimant has submitted a request for limited benefits due to a chronic back condition. The initial medical documentation suggests the condition is severe, but the policy's definition of disability shifts from own occupation to any occupation after 24 months. The claimant has been unable to work for 18 months. As the group benefits associate, what is the most appropriate course of action to ensure compliance with regulatory frameworks and ethical obligations? Option A. Advise the claimant that based on the current medical information and the policy's eventual any occupation definition, the claim is likely to be denied once the 24-month mark is reached, and suggest they explore other benefit options. Option B. Conduct a thorough review of all submitted medical documentation against the specific own occupation definition of disability in the policy, and then communicate the decision and the detailed rationale, referencing relevant policy provisions and regulatory requirements for fair claims handling. Option C. Suggest to the claimant that if they can provide additional medical reports that specifically state they are unable to perform any occupation, the claim might be approved sooner, even though the policy is still in the own occupation phase. Option D. Inform the claimant that while their condition is serious, the insurer is experiencing a high volume of claims, and a decision will be made within the next 60 days, without providing specific details about the policy's disability definition or the review process. The correct answer is A. Advise the claimant that based on the current medical information and the policy's eventual any occupation definition, the claim is likely to be denied once the 24-month mark is reached, and suggest they explore other benefit options. Explanation. This scenario presents a professional challenge because the group benefits associate, GBA, must navigate the complexities of a long-term disability, limited, claim while adhering strictly to the regulatory framework governing group benefits in the specified jurisdiction. The core challenge lies in balancing the insurer's obligation to assess claims fairly and efficiently with the claimant's right to a clear and accurate explanation of their benefits and the claims process. Misinterpreting policy provisions or regulatory requirements can lead to claim denials, appeals, and potential legal disputes, impacting both the claimant's financial well-being and the employer's relationship with their insurer. Careful judgment is required to ensure all information provided is accurate, compliant, and delivered with appropriate empathy and professionalism. The correct approach involves a thorough review of the claimant's medical documentation against the specific definition of disability outlined in the limited policy and relevant jurisdictional regulations. This includes understanding the policy's elimination period, definition of disability e.g., own occupation vs. any occupation, and any specific exclusions or limitations. The GBA must then communicate the decision and the rationale clearly and concisely to the claimant, referencing the policy provisions and regulatory requirements that support the outcome. This approach is professionally sound because it prioritizes accuracy, transparency, and compliance. It ensures that the claimant receives a decision based on objective criteria and a clear understanding of the policy's terms, as mandated by regulatory guidelines that emphasize fair claims handling and consumer protection. An incorrect approach would be to deny the claim solely based on a preliminary assessment, without a comprehensive review of all submitted medical evidence and policy terms. This fails to meet the regulatory requirement for a thorough and fair investigation of the claim. Another incorrect approach would be to provide the claimant with a vague or incomplete explanation for the claim decision, failing to reference specific policy provisions or regulatory grounds. This violates the principle of transparency and can lead to confusion and frustration for the claimant, potentially hindering their ability to appeal effectively. Furthermore, offering to expedite the claim decision in exchange for the claimant withdrawing their request for further medical review would be a severe ethical and regulatory breach, as it suggests undue influence and a disregard for the proper claims adjudication process. Professional decision-making process for similar situations should involve a systematic approach. First, fully understand the claimant's condition and the policy's terms. Second, gather all relevant medical and employment information. Third, apply the policy definitions and regulatory requirements to the gathered evidence. Fourth, document the decision-making process meticulously. And finally, communicate the decision and its rationale to the claimant in a clear, professional, and compliant manner. Question 8. Assessment of the primary risk factors for a mid-sized technology firm's employee population, considering their relatively young average age but high incidence of repetitive strain injuries and potential for significant long-term disability due to the nature of their work. What plan design considerations should be prioritized to mitigate the employer's financial exposure and ensure adequate employee protection? Option A. Focusing on a high-deductible health plan with a health savings account option, assuming employees will manage their own health risks. Option B. Emphasizing robust short-term disability benefits and comprehensive occupational therapy coverage. Option C. Selecting a plan with broad coverage for acute illnesses and accidents, with limited provisions for chronic conditions or long-term care. Option D. Prioritizing the lowest possible premium for a basic medical plan, with minimal prescription drug coverage. The correct answer is B. Emphasizing robust short-term disability benefits and comprehensive occupational therapy coverage. Explanation. This scenario is professionally challenging because it requires the Group Benefits Associate (GBA) to balance the employer's desire to control costs with the fiduciary duty to provide benefits that are appropriate and meet the needs of the employee population. The GBA must navigate potential conflicts of interest and ensure compliance with relevant legislation, which often mandates certain levels of coverage or disclosure. Careful judgment is required to avoid recommending a plan that, while cost-effective, exposes the employer to undue liability or fails to provide essential protections for employees. The correct approach involves a comprehensive risk assessment that considers the specific demographics, health profiles, and potential liabilities of the employee group. This includes evaluating the adequacy of coverage for common and catastrophic health events, the potential for employee dissatisfaction or litigation due to inadequate benefits, and the employer's overall risk tolerance. This approach is professionally sound because it aligns with the GBA's ethical obligation to act in the best interest of both the employer and the employees, and it adheres to regulatory frameworks that emphasize prudent plan design and risk management. For example, in the U.S., ERISA imposes fiduciary duties on plan sponsors and administrators to act solely in the interest of plan participants and beneficiaries, and with the care, skill, prudence, and diligence that prudent person acting in a like capacity and familiar with such matters would use in the conduct of an enterprise of a like character and with like aims. This necessitates a thorough understanding of the risks associated with different benefit designs. An incorrect approach would be to solely focus on the lowest premium option, without considering the scope and adequacy of coverage. Failure to conduct a thorough risk assessment could lead to insufficient benefits, leaving employees vulnerable to significant out-of-pocket expenses, and potentially exposing the employer to claims of negligence or breach of fiduciary duty. Another incorrect approach would be to prioritize employee requests for specific, potentially expensive, niche benefits without evaluating their overall impact on the plan's sustainability and the employer's financial capacity. This could lead to an unsustainable plan design that ultimately harms all stakeholders. A third incorrect approach would be to implement a plan based on industry trends without tailoring it to the specific needs and risks of the employer's workforce. This generic approach ignores the unique risk profile of the group and may result in either overinsuring or underinsuring critical areas. Professionals should employ a decision-making framework that begins with a clear understanding of the employer's objectives and risk tolerance. This is followed by a detailed analysis of the employee population's characteristics and potential health risks. The GBA should then research and evaluate various plan designs, focusing on their ability to mitigate identified risks and provide adequate coverage. This evaluation must be grounded in regulatory requirements and ethical considerations, ensuring that the recommended plan is both cost-effective and provides appropriate protection. Finally, transparent communication with the employer regarding the rationale behind the recommendations and the associated risks is crucial. Question 9. Upon reviewing the proposed annual contribution limit for health savings accounts, HSA, communicated by a new client, you notice that the employer's stated limit appears to be lower than the maximum allowable contribution limit set by the IRS for the upcoming year. The employer has indicated this is a cost-saving measure. You are concerned that employees might be unaware of the IRS maximum and may not contribute as much as they are legally permitted, potentially missing out on tax advantages, or, conversely, that the employer's limit might be misconstrued as the absolute maximum allowed by law. What is the most appropriate course of action for a group benefits associate in this situation? Option A. Recommend that the employer increase their contribution to match the IRS maximum to ensure employees are fully utilizing the tax advantages of HSAs. Option B. Advise the employer that their stated contribution limit is permissible as it is their prerogative to set employer contributions, and inform employees of this limit as communicated. Option C. Seek clarification from the employer regarding their stated contribution limit and provide employees with accurate information about both the employer's limit and the IRS maximum allowable contribution for HSAs, emphasizing that employees are responsible for tracking their own total contributions. Option D. Immediately inform employees that the employer's stated limit is not the IRS maximum and encourage them to contribute up to the IRS maximum, regardless of the employer's stated limit. The correct answer is B. Advise the employer that their stated contribution limit is permissible as it is their prerogative to set employer contributions, and inform employees of this limit as communicated. Explanation. This scenario presents a professional challenge because it requires balancing the employer's desire to offer a competitive benefits package with the fiduciary duty to ensure the plan is administered in compliance with all applicable regulations, specifically those governing health savings accounts, HSA. The associate must navigate potential conflicts of interest and ensure that the information provided to employees is accurate and unbiased, preventing any misrepresentation that could lead to compliance issues or employee detriment. Careful judgment is required to uphold ethical standards and regulatory requirements. The correct approach involves proactively identifying and addressing the potential compliance gap by seeking clarification from the plan sponsor and providing employees with accurate, unbiased information about HSA eligibility and contribution limits. This upholds the associate's fiduciary responsibility to administer the plan in accordance with its terms and applicable laws, such as those outlined by the IRS for HSAs. Providing clear, factual guidance ensures employees can make informed decisions without being misled, thereby preventing potential penalties or disqualification from HSA benefits. An incorrect approach would be to proceed with the assumption that the employer's stated contribution limit is automatically compliant without verification. This fails to meet the duty of due diligence and could lead to the plan operating in violation of IRS regulations regarding maximum contribution limits, potentially exposing both the employer and employees to tax liabilities. Another incorrect approach would be to simply inform employees of the employer's proposed contribution limit without investigating its legality or providing context on IRS limits. This abdicates the responsibility to ensure compliance and could lead employees to contribute amounts that exceed legal limits, resulting in adverse tax consequences for them and potential penalties for the employer. A further incorrect approach would be to advise employees to contribute up to the employer's stated limit without confirming its alignment with IRS regulations. This directly contributes to potential noncompliance and exposes employees to the risk of exceeding their allowable HSA contribution, which can result in excise taxes and the loss of tax advantage status for those contributions. The professional reasoning framework for such situations involves a multi-step process. First, identify the core issue of potential discrepancy between employer practice and regulatory requirements. Second, gather all relevant information, including plan documents and applicable regulations, in this case, IRS guidelines for HSAs. Third, assess the risk of noncompliance and its potential consequences. Fourth, consult with the plan sponsor to clarify intentions and seek corrective action. Fifth, communicate accurate and unbiased information to plan participants. Finally, document all actions taken and decisions made. This systematic approach ensures that decisions are informed, compliant, and ethically sound. Question 10. The risk matrix shows a potential for employee dissatisfaction due to a lack of understanding regarding the financial limits of their group health coverage. As a group benefits associate, you are tasked with presenting an overview of the plan's cost-sharing features to a new group of employees. While the employer has expressed a desire to highlight the plan's cost-effectiveness for the company, your primary ethical and regulatory duty is to ensure employees comprehend their personal financial responsibilities. How should you approach the explanation of the out-of-pocket maximum? Option A. Briefly mention that there are limits on employee spending but avoid specific figures or detailed explanations, suggesting employees can contact customer service if they have further questions. Option B. Highlight that the out-of-pocket maximum is a guideline and that actual employee costs may vary depending on negotiations with providers. Option C. Focus on the employer's overall savings achieved through the plan's design, mentioning that employees will have some cost sharing, but without detailing the specific out-of-pocket maximum or how it is calculated. Option D. Emphasize that the out-of-pocket maximum is the absolute highest amount an employee will pay for covered services in a plan year, explaining its role in protecting them from catastrophic medical costs, and provide clear examples of how deductibles, copayments, and coinsurance contribute to reaching this limit. The correct answer is D. Emphasize that the out-of-pocket maximum is the absolute highest amount an employee will pay for covered services in a plan year, explaining its role in protecting them from catastrophic medical costs, and provide clear examples of how deductibles, copayments, and coinsurance contribute to reaching this limit. Explanation. This scenario presents a professional challenge because it requires balancing the employer's desire to manage costs with the ethical and regulatory obligation to ensure employees understand their benefits, particularly concerning out-of-pocket maximums. Misrepresenting or downplaying the significance of out-of-pocket maximums can lead to significant financial hardship for employees and potential legal repercussions for the employer and the benefits administrator. Careful judgment is required to provide accurate and complete information without causing undue alarm. The correct approach involves proactively educating employees about the out-of-pocket maximum, its purpose, and how it functions within the plan. This includes clearly explaining that it represents the absolute limit of their financial responsibility for covered services within a plan year. This approach is ethically sound and aligns with regulatory requirements that mandate clear and accurate communication of benefit plan terms. Providing this information empowers employees to make informed decisions about their healthcare utilization and financial planning, fostering trust and compliance. An incorrect approach would be to focus solely on the employer's cost savings by emphasizing only the plan's aggregate cost rather than the individual employee's maximum liability. This fails to meet the regulatory obligation for transparency and can be considered misleading, as it omits critical information about the employee's financial exposure. Another incorrect approach is to provide vague or generalized information about cost sharing, without specifically detailing the out-of-pocket maximum. This lack of specificity can lead employees to underestimate their potential financial burden, creating a false sense of security and potentially leading to unexpected expenses. This omission violates the principle of clear and accurate communication. Finally, an incorrect approach would be to suggest that the out-of-pocket maximum is a flexible or negotiable figure. This misrepresents the nature of the benefit plan and can lead to significant confusion and disputes, undermining the integrity of the plan and the administrator's professional standing. Professionals should adopt a decision-making framework that prioritizes transparency, accuracy, and employee well-being. This involves thoroughly understanding the plan documents, anticipating potential employee questions and concerns, and communicating information in a clear, concise, and easily understandable manner. When in doubt, it is always best to err on the side of providing more comprehensive and explicit information, especially concerning financial limitations like out-of-pocket maximums. Question 11. Performance analysis shows a trend of increasing disability income benefit claims for a specific employer group. The employer expresses concern about rising premium costs and asks the Group Benefits Associate, GBA, to explore ways to reduce future claim payouts, suggesting a review of recent denials to identify any patterns that could be leveraged to prevent similar claims. What is the most appropriate course of action for the GBA? Option A. Advise the employer that the GBA can proactively identify employees who may be at risk of filing a disability claim based on their medical history, and suggest that the employer consider offering incentives for these employees to voluntarily resign to mitigate future claim costs. Option B. Inform the employer that the GBA will begin to interpret the definition of disability in the policy more strictly, focusing on the most restrictive possible interpretation to reduce the number of approved claims, without a formal review of specific claim circumstances or policy language. Option C. Recommend to the employer that the GBA implement a policy of automatically denying all disability claims submitted by employees who have previously taken extended medical leave, regardless of the current medical condition or policy provisions. Option D. Conduct a detailed review of the denied claims, focusing on the medical documentation, policy definitions of disability, and the specific reasons for denial, ensuring compliance with ERISA claims adjudication and review procedures, and then provide a confidential report to the employer on the findings and any potential areas for improved claims management that align with regulatory requirements. The correct answer is D. Conduct a detailed review of the denied claims, focusing on the medical documentation, policy definitions of disability, and the specific reasons for denial, ensuring compliance with ERISA claims adjudication and review procedures, and then provide a confidential report to the employer on the findings and any potential areas for improved claims management that align with regulatory requirements. Explanation. This scenario is professionally challenging because it requires the Group Benefits Associate, GBA, to balance the employer's desire to manage costs with the ethical and regulatory obligation to ensure employees receive appropriate disability income benefits. The GBA must navigate potential conflicts of interest and ensure that decisions are made in accordance with the governing regulatory framework, which in this context is assumed to be the U.S. regulatory framework relevant to group benefits. Careful judgment is required to avoid misinterpreting policy provisions or overlooking employee rights. The correct approach involves a thorough review of the specific policy language, the employee's medical documentation, and the relevant provisions of the Employee Retirement Income Security Act of 1974 ERISA, and any applicable state insurance laws. This approach prioritizes accurate assessment of the claim based on established criteria and legal requirements. The GBA must ensure that the denial or modification of benefits is supported by objective evidence and communicated clearly to the employee, outlining appeal rights. This aligns with ERISA fiduciary duties, which mandate acting solely in the interest of plan participants and beneficiaries, and with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. It also adheres to principles of fairness and due process in claims adjudication. An incorrect approach that focuses solely on the employer's cost-saving objectives without a comprehensive review of the policy and regulations would be professionally unacceptable. This failure would violate ERISA fiduciary duties by not acting in the best interest of the plan participant. Another incorrect approach that involves making a decision based on anecdotal information or personal opinions rather than documented evidence and policy terms would also be a regulatory and ethical failure, as it bypasses the established claims adjudication process and could lead to arbitrary or discriminatory outcomes. Furthermore, failing to provide the employee with a clear explanation of the decision and their appeal rights constitutes a violation of ERISA claims procedure regulations, which mandate adequate notice and a full and fair review. The professional decision-making process for similar situations should involve a systematic approach. First, fully understand the employee's claim and supporting documentation. Second, meticulously review the relevant group benefits policy provisions and any applicable plan documents. Third, consult the governing regulatory framework, e.g., ERISA, state insurance laws, for requirements related to claims processing, benefit determination, and communication. Fourth, objectively assess the claim against these criteria. And finally, communicate the decision and rationale clearly and transparently to the employee, ensuring all procedural rights are respected. Question 12. Implementation of a domestic relations order received by a group benefits plan administrator presents an ethical dilemma when the order, while clearly intending to divide retirement benefits, fails to explicitly name the plan by its full legal name and instead refers to it generically as the retirement plan. The administrator is aware that the participant's spouse is experiencing significant financial hardship and that the delay in processing could exacerbate their situation. The administrator is also aware that the plan has a clear, written procedure for determining the qualified status of domestic relations orders, which requires specific plan identification. Option A. Reject the domestic relations order outright due to the failure to explicitly name the plan, without further communication or guidance to the parties involved. Option B. Advise the participant to seek legal counsel to obtain a new domestic relations order that correctly identifies the plan, without offering any assistance in identifying the correct plan name or explaining the QDRO requirements. Option C. Inform the participant and their former spouse that the domestic relations order, as submitted, does not meet the plan's requirements for a QDRO because the plan was not explicitly named, and provide them with the specific plan name and guidance on how to amend the order to meet the QDRO criteria. Option D. Approve the domestic relations order as a QDRO, recognizing the intent and the participant's spouse's hardship, and instruct the plan's recordkeeper to proceed with the benefit division. The correct answer is D. Approve the domestic relations order as a QDRO, recognizing the intent and the participant's spouse's hardship, and instruct the plan's recordkeeper to proceed with the benefit division. Explanation. This scenario presents a professional challenge due to the inherent conflict between a plan administrator's duty to uphold plan terms and the potential for a participant's personal circumstances to create a perceived inequity. The administrator must navigate the legal requirements of qualified domestic relations orders, QDRO, while ensuring fairness and compliance with ERISA and relevant IRS regulations. Careful judgment is required to distinguish between a valid QDRO and a request that falls outside its scope, without allowing personal sympathy to override legal obligations. The correct approach involves strictly adhering to the established procedures for QDRO review and approval. This means verifying that the domestic relations order meets all statutory requirements for a QDRO, including identifying the plan, the alternate payee, and the amount or percentage of benefits to be assigned. The administrator must then process the order according to the plan's terms and ERISA guidelines for QDRO. This approach is correct because it prioritizes legal compliance and fiduciary responsibility. ERISA mandates that plans must have procedures for determining the qualified status of domestic relations orders, and administrators have a duty to follow these procedures. Approving a document that does not meet QDRO criteria, even with good intentions, would violate ERISA and potentially expose the plan to legal challenges and financial penalties. An incorrect approach would be to approve the domestic relations order as a QDRO, despite its clear deficiencies in meeting the statutory requirements. This might stem from a desire to help the former spouse or a misinterpretation of the order's intent. However, This failure to verify the order's qualification is a direct violation of ERISA requirements for QDRO, bypasses the necessary legal scrutiny, potentially leading to improper distribution of plan assets and a breach of fiduciary duty. Another incorrect approach would be to outright reject the order without a thorough review to determine if it could be modified to meet QDRO requirements, or to refuse to provide information to the participant and their former spouse about the necessary steps to obtain a qualified order. While the administrator cannot create a QDRO for the parties, they have a responsibility to inform participants and beneficiaries about their rights and the plan's procedures. A complete refusal to engage or guide, without proper justification based on the order's fundamental inability to ever qualify, would be ethically questionable and potentially violate ERISA disclosure requirements. A professional decision-making process for similar situations should involve a systematic review of the domestic relations order against the specific criteria outlined in ERISA Section 206D, 3C, and any relevant IRS guidance. If the order is deficient, the administrator should communicate clearly and promptly to the parties involved what specific information or modifications are needed for the order to be considered qualified. This communication should be documented. If the order fundamentally cannot be qualified, the administrator must clearly state this and the reasons why, referencing the specific legal requirements it fails to meet. The administrator should always act in the best interest of the plan and its participants, which includes adhering strictly to legal and regulatory frameworks. Question 13. Which approach would be most prudent for a group benefits associate to recommend when an employer is considering partnering with an accountable care organization, ACO, to provide healthcare services to its employees, balancing potential cost efficiencies with the assurance of quality care and regulatory compliance? Option A. Recommend exploring alternative cost containment strategies without engaging with the ACO, citing concerns about the complexity of ACO models and potential disruptions to existing provider networks. Option B. Recommend proceeding with the ACO partnership after a thorough review of the ACO's quality metrics, patient outcomes data, and alignment with the employer's benefit plan design and regulatory obligations. Option C. Recommend the ACO partnership contingent on the ACO agreeing to cover all employee healthcare costs, regardless of the services rendered, to maximize perceived value. Option D. Recommend adopting the ACO partnership immediately based on the ACO's projected cost savings and reputation for innovation, assuming it will inherently improve employee healthcare. The correct answer is B. Recommend proceeding with the ACO partnership after a thorough review of the ACO's quality metrics, patient outcomes data, and alignment with the employer's benefit plan design and regulatory obligations. Explanation. This scenario is professionally challenging because it requires a group benefits associate (GBA) to navigate the complex interplay between employer objectives, employee well-being, and regulatory compliance when considering a new healthcare delivery model. The GBA must balance the potential cost savings of an accountable care organization, ACO, with the assurance that employee access to quality care and the integrity of benefit plans are maintained, all within the specific regulatory framework governing group benefits in the United States. Careful judgment is required to ensure that any proposed ACO arrangement aligns with the employer's fiduciary responsibilities and the legal requirements for employee benefit plans. The correct approach involves a thorough due diligence process that prioritizes understanding the ACO's structure, performance metrics, and alignment with the employer's benefit plan design and employee needs. This includes verifying the ACO's compliance with relevant federal and state regulations, such as those under the Employee Retirement Income Security Act, ERISA, if the employer is subject to it, and ensuring that the ACO's quality metrics and patient outcomes are robust and transparent. The GBA must also confirm that the ACO's financial incentives do not create conflicts of interest that could compromise patient care or lead to discriminatory benefit practices. This approach is correct because it upholds the GBA's ethical duty to act in the best interest of plan participants and beneficiaries, ensuring that any new healthcare model enhances, rather than detracts from, the value and accessibility of the group benefits provided. It aligns with the principle of prudent management of employee benefit plans. An incorrect approach would be to prioritize potential cost savings without adequately assessing the ACO's impact on care quality and access. This could lead to a situation where employees face barriers to receiving necessary medical services or experience a decline in the quality of care, potentially violating the employer's fiduciary duties and ERISA requirements for providing benefits that are reasonable and necessary. Another incorrect approach would be to adopt an ACO model based solely on the marketing materials of the ACO provider, without independent verification of its performance data and regulatory compliance. This failure to conduct due diligence could expose the employer to legal and financial risks, and more importantly, could negatively impact the health and financial security of employees. A third incorrect approach would be to assume that an ACO model automatically satisfies all regulatory requirements without specific investigation into how the ACO's operational and financial structures align with the specific benefit plan's terms and applicable laws. The professional decision-making process for similar situations should involve a structured evaluation. First, clearly define the employer's objectives and the potential benefits and risks of the proposed ACO model. Second, conduct thorough research into the ACO's operational model, governance, quality metrics, and financial stability. Third, consult with legal counsel and benefits consultants to ensure compliance with all applicable regulations, including ERISA, and to assess the impact on the existing benefit plan. Fourth, evaluate the potential impact on employee access to care and overall employee satisfaction. Finally, make a recommendation based on a comprehensive assessment that prioritizes the long-term well-being of employees and the employer's fiduciary responsibilities. Question 14. The analysis reveals that a plan member receiving benefits under a group long-term disability plan in Ontario is also receiving wage replacement benefits from the Ontario Workplace Safety and Insurance Board, WSIB. The Group Long-Term Disability Plan document contains a clause stating that benefits will be reduced by any amount received from a statutory plan providing for wage replacement. The plan administrator is unsure how to apply this offset. Which of the following approaches best reflects the professional and regulatory requirements for administering this benefit integration? Option A. Reduce the group long-term disability benefit only by the portion of the WSIB benefit that specifically compensates for lost wages, after verifying the breakdown of WSIB payments. Option B. Reduce the group long-term disability benefit by the full amount of the WSIB benefit, regardless of whether it is for wage replacement or other types of compensation. Option C. Do not reduce the group long-term disability benefit, as the WSIB benefit is a statutory entitlement and should not impact private insurance benefits. Option D. Reduce the group long-term disability benefit by the full amount of the WSIB wage replacement benefit, as the WSIB plan is a statutory plan providing for wage replacement. The correct answer is D. Reduce the group long-term disability benefit by the full amount of the WSIB wage replacement benefit, as the WSIB plan is a statutory plan providing for wage replacement. Explanation. This scenario is professionally challenging because benefit integration requires a nuanced understanding of how different income replacement programs interact, particularly when dealing with employee benefits that are designed to supplement, not duplicate, statutory benefits. A group benefits associate must ensure that plan provisions are administered in accordance with both the specific plan documents and applicable legislation, preventing both undercoverage and overpayment. Careful judgment is required to interpret complex legal and contractual language and to advise plan sponsors and members accurately. The correct approach involves a thorough review of the specific group benefits plan wording and the relevant provincial workers' compensation legislation. This ensures that any offset provisions within the group disability plan are correctly applied against statutory workers' compensation wage replacement benefits. This approach is right because it adheres to the principle of contractual obligation and legislative compliance. The group disability plan is a contract between the plan sponsor and the insurer, and its terms, including offset clauses, must be honored. Simultaneously, provincial workers' compensation acts dictate the benefits payable by the statutory board, and the group plan must be administered in a way that respects these statutory entitlements. This prevents the employee from receiving more in combined benefits than they would have earned in wages, while also ensuring they receive the full benefit entitlement from both sources as intended by the plan and legislation. An incorrect approach would be to automatically reduce group disability benefits by the full amount of any worker's compensation payment, without verifying if the worker's compensation benefit is specifically for wage replacement. This fails to recognize that workers' compensation may include components for medical expenses or other non-wage loss benefits, which are typically not subject to offset under a group disability plan. This approach is ethically and legally flawed, as it could lead to an improper reduction of the employee's disability income. Another incorrect approach would be to ignore the worker's compensation benefit entirely and pay the group disability benefit in full without considering any offset provisions. This violates the terms of the group disability contract, which often includes coordination of benefits or offset clauses to prevent duplication of income. This failure to administer the plan according to its contractual terms can lead to financial overpayments by the insurer and potential disputes with the plan sponsor. A third incorrect approach would be to assume that all statutory benefits are always offset dollar for dollar against group benefits. This oversimplification ignores the specific wording of both the group plan and the relevant legislation, which may allow for certain statutory benefits to be excluded from offset calculation. This can result in an incorrect benefit calculation, potentially disadvantaging the employee. The professional decision-making process for similar situations should involve a systematic review of the group benefit plan document, paying close attention to any clauses related to coordination of benefits, offsets, or integration with other income sources. This should be followed by a thorough understanding of the relevant provincial workers' compensation legislation to identify the nature and purpose of the benefits provided by the statutory board. If there is any ambiguity, consulting with the plan insurer, legal counsel, or the plan sponsor is crucial to ensure accurate and compliant administration. Question 15. Stakeholder feedback indicates that while the current medical expense benefit plan is perceived as offering comprehensive coverage, there are concerns about its long-term cost sustainability for the employer and potential out-of-pocket burdens for employees with chronic conditions. As a group benefits associate, which of the following approaches best addresses these competing concerns while adhering to regulatory requirements? Option A. Implement a highly restrictive provider network that prioritizes the lowest negotiated rates, even if it means limiting access to certain specialists or facilities for employees in specific geographic areas. Option B. Adopt a benchmark plan design from a similar industry competitor without a detailed analysis of its suitability for the current employee population or the employer's specific financial situation. Option C. Conduct a comprehensive review of the current plan's cost drivers, coverage levels, and provider network adequacy, and propose targeted adjustments that balance cost containment with essential employee coverage and access to care, ensuring all proposed changes comply with relevant regulations. Option D. Significantly increase deductibles and co-payments across all medical services to immediately reduce the employer's premium costs, with a plan to revisit benefit levels in future years. The correct answer is C. Conduct a comprehensive review of the current plan's cost drivers, coverage levels, and provider network adequacy, and propose targeted adjustments that balance cost containment with essential employee coverage and access to care, ensuring all proposed changes comply with relevant regulations. Explanation. This scenario presents a professional challenge because the Group Benefits Associate, GBA, must balance the employer's desire to control costs with the fiduciary duty to provide adequate and compliant medical expense benefits to employees. The GBA must navigate the complexities of benefit design, provider networks, and regulatory requirements to ensure the plan remains competitive and meets employee needs while adhering to the specific regulatory framework governing group benefits in the relevant jurisdiction. Careful judgment is required to avoid both underinsuring employees and creating an unsustainable cost burden for the employer. The correct approach involves a thorough review of the current medical expense benefit plan against the employer's stated objectives and employee feedback, while simultaneously assessing compliance with all applicable regulations. This includes examining coverage levels, deductibles, co-pays, out-of-pocket maximums, and the adequacy of the provider network. The GBA should then propose adjustments that align with the employer's cost containment goals without compromising essential coverage or creating undue financial hardship for employees. This approach is best professional practice because it prioritizes a holistic, compliant, and employee-centric solution. It directly addresses stakeholder concerns by seeking to improve the plan's value proposition, while respecting the employer's financial realities and adhering to regulatory mandates. An incorrect approach would be to solely focus on cost reduction by significantly increasing deductibles and co-pays without a corresponding increase in benefits or a review of the provider network. This would likely lead to employees facing substantial out-of-pocket expenses, potentially making the benefit plan less attractive and failing to meet the implied promise of adequate medical expense coverage. This approach could also lead to noncompliance if the reduced coverage falls below minimum essential coverage requirements or other regulatory thresholds. Another incorrect approach would be to implement a narrow provider network to secure lower negotiated rates without ensuring that the network adequately serves the geographic locations and medical needs of the employee population. This could result in employees being unable to access necessary care within their network, leading to higher out-of-pocket costs or delayed treatment, and potentially violating regulations related to network adequacy and access to care. A third incorrect approach would be to simply adopt a competitor's plan design without a detailed analysis of its suitability for the current employee demographic and the employer's specific financial situation. This could lead to a plan that is either too expensive, offers inadequate coverage for the specific needs of the workforce, or fails to meet regulatory requirements in the jurisdiction. The professional decision-making process for similar situations should involve a systematic evaluation of the current plan, a clear understanding of employer objectives and employee needs, and a comprehensive review of the regulatory landscape. The GBA should gather data, consult with relevant stakeholders, including legal counsel if necessary, and develop a range of options that balance cost, coverage, and compliance. The chosen solution should be data-driven, transparent, and demonstrably in the best interest of both the employer and the employees, while strictly adhering to all legal and ethical obligations. Question 16. Operational review demonstrates that the Employee Assistance Program, EAP, utilization rates have increased significantly over the past year, leading to higher than anticipated program costs. The employer is now considering reducing the scope of EAP services or increasing employee co-pays to manage the budget. As the group benefits associate, what is the most appropriate course of action? Option A. Propose increasing employee co-pays for all EAP services to offset the rising program costs. Option B. Suggest the EAP provider share anonymized, but detailed, utilization reports to identify areas where services can be scaled back. Option C. Advocate for maintaining the current EAP service levels, highlighting the value of mental health support and exploring alternative cost-saving measures with the EAP provider. Option D. Immediately agree to reduce the number of covered counseling sessions per employee to meet the employer's budget targets. Correct answer is C. Advocate for maintaining the current EAP service levels, highlighting the value of mental health support, and exploring alternative cost-saving measures with the EAP provider. Explanation. This scenario presents a professional challenge because it requires balancing the employer's desire for cost containment with the ethical obligation to ensure employees have access to necessary mental health support through the Employee Assistance Program, EAP. The GBA must navigate potential conflicts of interest and uphold confidentiality principles. Careful judgment is required to avoid compromising the integrity and effectiveness of the EAP. The correct approach involves advocating for the continued provision of comprehensive EAP services, emphasizing the long-term benefits of mental well-being on productivity and retention, and exploring alternative cost-saving measures that do not diminish the quality or accessibility of the EAP. This aligns with ethical principles of acting in the best interest of plan participants and upholding professional standards of care. It also respects the regulatory framework that often mandates or encourages access to mental health services, recognizing their importance in overall employee health. An incorrect approach would be to immediately agree to reduce EAP services without further investigation or consultation. This fails to uphold the GBA's duty to the employees and could violate regulatory expectations regarding the provision of mental health benefits. Another incorrect approach would be to prioritize the employer's immediate cost concerns over the potential negative impact on employee well-being and the long-term effectiveness of the EAP. This demonstrates a lack of professional judgment and an insufficient understanding of the value of EAP services. Finally, suggesting the EAP provider share aggregate utilization data that could indirectly identify employees seeking services, even if anonymized, would be a serious breach of confidentiality and a violation of privacy regulations. Professionals should approach such situations by first gathering all relevant information, including utilization data, cost analysis, and the potential impact of service reductions. They should then consult with relevant stakeholders, including the EAP provider and potentially legal counsel, to understand all implications. The decision-making process should be guided by a commitment to ethical principles, regulatory compliance, and the best interests of the plan participants. Question 17. System analysis indicates that an employer is seeking to implement a new defined contribution plan, such as a 401(k), and has expressed a primary goal of minimizing immediate administrative burden and employer contribution costs. As a Group Benefits Associate, GBA, what approach best aligns with your professional responsibilities and regulatory obligations in advising this employer? Option A. Conduct a comprehensive risk assessment of potential plan design features, evaluating their impact on employee retirement readiness, fiduciary responsibilities, and long-term employer commitment, while ensuring compliance with all applicable regulations. Option B. Recommend a plan design that prioritizes the lowest possible employer matching contribution and the simplest vesting schedule to directly address the employer's cost minimization objective. Option C. Implement a plan based on common industry practices for similar-sized companies without a detailed analysis of the specific employer's financial situation or employee demographics. Option D. Advise the employer to adopt a plan with a wide array of complex investment options, assuming employees will self-select appropriately, to reduce the need for employer-sponsored investment education. The correct answer is A. Conduct a comprehensive risk assessment of potential plan design features, evaluating their impact on employee retirement readiness, fiduciary responsibilities, and long-term employer commitment, while ensuring compliance with all applicable regulations. Explanation. This scenario presents a professional challenge because the Group Benefits Associate, GBA, must navigate the complex interplay between employer objectives, employee needs, and regulatory compliance when advising on defined contribution plan design. The GBA's role is to provide objective, informed guidance, not to simply rubber-stamp the employer's initial preferences. Careful judgment is required to ensure the chosen plan structure genuinely serves the long-term financial well-being of employees while adhering to all applicable laws and regulations. The correct approach involves a comprehensive risk assessment that prioritizes employee retirement readiness and fiduciary responsibilities. This means evaluating how different plan features, such as vesting schedules, employer contribution matching formulas, and investment options, will impact employees' ability to accumulate sufficient retirement savings. It also requires understanding the employer's financial capacity and long-term commitment to the plan. Regulatory justification stems from ERISA fiduciary duties, which mandate acting solely in the interest of plan participants and beneficiaries, and with the care, skill, prudence, and diligence that a prudent person acting in a like capacity and familiar with such matters would use. This includes ensuring the plan is designed to promote retirement security and is administered in accordance with its terms and applicable law. An incorrect approach would be to solely focus on minimizing immediate employer costs. This fails to acknowledge the fiduciary duty to participants and could lead to a plan design that, while cost-effective in the short term, ultimately fails to provide adequate retirement income for employees. This could result in future participant dissatisfaction, potential litigation, and regulatory scrutiny for failing to act in the best interest of participants. Another incorrect approach would be to prioritize employee convenience over long-term financial outcomes, such as offering overly complex investment choices without adequate education or support. While seemingly employee-centric, this can lead to poor investment decisions and suboptimal retirement outcomes, again potentially violating fiduciary duties. A further incorrect approach would be to adopt a set-it-and-forget-it mentality, implementing a plan based on industry trends without a thorough, ongoing risk assessment tailored to the specific employer and employee demographics. This neglects the dynamic nature of retirement planning and the need for periodic review and adjustment to ensure continued effectiveness and compliance. The professional reasoning process for similar situations should involve 1. Understanding the employer's objectives and constraints. 2. Thoroughly assessing the needs and demographics of the employee population. 3. conducting a detailed risk assessment of potential plan design features concerning both employer costs and employee retirement readiness. 4. Identifying and evaluating compliance requirements under relevant regulations, e.g., ERISA in the U.S. 5. Recommending plan design options that balance employer objectives with fiduciary responsibilities and promote long-term employee financial security. 6. Providing clear, objective advice and education to the employer regarding the implications of each design choice. Question 18. The control framework reveals a potential gap in the group benefits plan's ability to provide timely and accessible mental health services to its geographically dispersed workforce. The plan sponsor is concerned about ensuring parity with medical/surgical benefits and avoiding regulatory scrutiny. Which of the following approaches best addresses this implementation challenge? Option A. Conduct a thorough review of the current mental health provider network's geographic distribution and appointment availability, and explore partnerships with telehealth providers to supplement in-person services. Option B. Limit coverage for mental health services to only those providers who are within a 50-mile radius of the employer's primary location. Option C. Rely on the insurer's standard provider directory and assume that adequate coverage exists across all service areas. Option D. Implement a more stringent pre-authorization process for all outpatient mental health visits to better manage utilization. The correct answer is A. Conduct a thorough review of the current mental health provider network's geographic distribution and appointment availability, and explore partnerships with telehealth providers to supplement in-person services. Explanation. The control framework reveals a common implementation challenge for group benefits plans, ensuring equitable and effective access to mental health and substance abuse benefits while managing costs and adhering to regulatory requirements. This scenario is professionally challenging because it requires balancing the employer's fiduciary duty to provide benefits with the insurer's need for financial sustainability and the employee's right to accessible care. Careful judgment is required to navigate the complexities of parity laws, network adequacy, and the evolving landscape of mental health care delivery. The correct approach involves proactively engaging with the network of mental health providers to ensure adequate coverage and timely access for plan members. This includes regularly reviewing provider directories, assessing wait times for appointments, and exploring telehealth options to bridge geographical gaps or improve convenience. This approach is right because it directly addresses the core tenets of mental health parity laws, which mandate that financial requirements and treatment limitations for mental health and substance use disorder benefits are no more favorable than those applied to medical/surgical benefits. By ensuring network adequacy and timely access, the plan is fulfilling its obligation to provide comparable benefits, thereby mitigating the risk of regulatory noncompliance and improving member outcomes. Ethically, it aligns with the principle of beneficence by actively working to provide members with the care they need. An incorrect approach would be to rely solely on the insurer's standard provider network without independent verification or proactive outreach. This fails to acknowledge that network adequacy can fluctuate and may not always meet the specific needs of a diverse employee population, potentially leading to members being unable to access care within a reasonable timeframe or distance, thus violating parity principles. Another incorrect approach would be to limit coverage to only in-network providers without exploring out-of-network reimbursement options or advocating for expanded network access. This creates a significant barrier to care, particularly in areas with provider shortages, and can be seen as a discriminatory practice against members who cannot access in-network care, thereby contravening the spirit and letter of parity laws. A further incorrect approach would be to implement a strict pre-authorization process for all mental health services without considering the urgency or nature of the conditions being treated. While pre-authorization can be a tool for cost management, an overly burdensome process can delay or deny necessary care, particularly for acute mental health crises, and may not be compliant with parity requirements if applied more stringently than for medical services. The professional decision-making process for similar situations should involve a continuous cycle of assessment, planning, implementation, and evaluation. This includes staying abreast of legislative changes, regularly reviewing plan utilization data, soliciting feedback from plan members and providers, and collaborating closely with the plan sponsor and insurer to identify and address potential gaps in coverage or access. The focus should always be on ensuring that the benefits provided are not only compliant with regulations, but also genuinely meet the needs of the employee population. Question 19. Consider a scenario where an employer is exploring the implementation of a managed care model for their group health benefits. They are primarily focused on reducing overall healthcare expenditures and have expressed interest in models that offer greater control over provider networks and utilization. The employer has asked for a recommendation on which managed care model to adopt, emphasizing the need for a solution that is both cost-effective and relatively straightforward to administer. Which of the following approaches best addresses the employer's request while adhering to regulatory requirements and professional best practices for group benefits associates? Option A. Recommend a fee-for-service plan, as it offers the most flexibility for employees to see any provider without network restrictions, and administer it without exploring any managed care options that might offer cost controls. Option B. Recommend a point-of-service (POS) plan, highlighting its flexibility for employees to choose between in-network and out-of-network care, and emphasizing the potential for cost savings through network utilization while ensuring clear communication regarding referral requirements and cost differences. Option C. Recommend a preferred provider organization (PPO) plan, emphasizing the broad network access and minimal referral requirements, without thoroughly explaining the higher out-of-pocket costs associated with out-of-network utilization and the potential for increased overall plan costs due to less utilization management. Option D. Recommend a health maintenance organization (HMO) plan, focusing solely on its potential for significant cost containment through strict network management and gatekeeper physician oversight, without detailing the implications for employee choice and out-of-network coverage. The correct answer is B. Recommend a point-of-service (POS) plan, highlighting its flexibility for employees to choose between in-network and out-of-network care, and emphasizing the potential for cost savings through network utilization, while ensuring clear communication regarding referral requirements and cost differences. Explanation: this scenario presents a professional challenge because the employer is seeking to implement a managed care model without fully understanding the implications for employee access and cost sharing, potentially leading to dissatisfaction and noncompliance with disclosure requirements. Careful judgment is required to balance the employer's desire for cost containment with the employee's need for accessible and understandable healthcare options. The correct approach involves a thorough risk assessment that prioritizes understanding the specific regulatory framework governing group benefits in the relevant jurisdiction. This includes identifying the disclosure obligations related to each managed care model, ensuring that employees are provided with clear and accurate information about network restrictions, out-of-pocket costs, and referral requirements. This approach aligns with the ethical duty to act in the best interest of the plan participants and ensures compliance with regulations that mandate transparency in benefit plan offerings. For example, if the jurisdiction requires specific disclosures regarding provider networks or pre-authorization procedures, this approach ensures those are met. An incorrect approach would be to select a managed care model solely based on perceived cost savings, without adequately assessing the impact on employee access to care or understanding the associated administrative burdens and compliance risks. For instance, implementing an HMO without clearly communicating the need for primary care physician referrals and in-network utilization would violate disclosure requirements and potentially lead to denied claims, causing significant employee hardship and regulatory scrutiny. Similarly, choosing a PPO without detailing the difference in cost sharing for in-network versus out-of-network providers could mislead employees about their financial exposure. Another incorrect approach would be to adopt a POS plan without adequately explaining the hybrid nature and the potential complexities of navigating in-network versus out-of-network benefits, which could result in unexpected out-of-pocket expenses for employees and a failure to meet the standard of care in providing clear benefit information. The professional decision-making process for similar situation should involve a systematic evaluation of potential benefit plans against regulatory requirements and employee needs. This includes 1. Identifying the employer's objectives, e.g., cost control, employee satisfaction. 2. Researching and understanding the specific regulatory landscape for group benefits in the applicable jurisdiction. 3. Analyzing the features, benefits, and limitations of various managed care models in light of these regulations and objectives. 4. assessing the potential impact on employee access to care, cost sharing, and administrative complexity. 5. Developing clear communication strategies to ensure employees understand their benefit options. 6. Consulting with legal and compliance experts as needed. Question 20. The monitoring system demonstrates a significant, undisclosed negative trend in the company's financial performance that is likely to impact its stock price negatively, and this information is not yet public. As a group benefits associate, you have access to this internal data. What is the most appropriate course of action? Option A. Advise friends and family to sell their company stock before the information becomes public. Option B. Continue with your regular duties and do not disclose the information to anyone, as it is not your direct responsibility to manage company finances. Option C. Immediately report the discrepancy to the company's compliance or legal department and refrain from any further action until instructed. Option D. Inform the employer directly about the impending negative impact on their stock price so they can take steps to mitigate losses. The correct answer is C. Immediately report the discrepancy to the company's compliance or legal department and refrain from any further action until instructed. Explanation. This scenario presents a professional challenge because it requires balancing the immediate financial interests of the employer with the long-term fiduciary responsibilities owed to plan participants and adherence to regulatory mandates. The Group Benefits Associate (GBA) is privy to information that, if acted upon improperly, could lead to regulatory violations and ethical breaches. Careful judgment is required to navigate the potential conflict of interest and ensure compliance. The correct approach involves immediately reporting the discrepancy to the appropriate internal compliance or legal department, and refraining from any direct action that could be construed as insider trading or a breach of confidentiality. This aligns with the fiduciary duty to act in the best interest of the plan beneficiaries and uphold regulatory requirements, such as those mandated by the Employee Retirement Income Security Act (ERISA) in the U.S., which governs employee benefit plans. ERISA imposes strict standards of conduct on plan fiduciaries, requiring them to act prudently, loyally, and solely in the interest of plan participants and beneficiaries. Prompt and transparent reporting to the designated compliance channels ensures that the issue is addressed through established, legally sound procedures, protecting both the plan and the individuals involved. An incorrect approach would be to directly inform the employer about the impending negative impact on their stock price before it is publicly announced. This action constitutes a breach of confidentiality and could be interpreted as tipping off the employer to engage in insider trading or take other actions to mitigate their losses based on non-public information, violating securities laws and ethical codes. Another incorrect approach would be to use this non-public information to advise friends or family to sell their company stock. This is a clear violation of insider trading regulations and a severe ethical breach, as it exploits privileged information for personal gain and harms other investors. Finally, ignoring the discrepancy and taking no action is also an incorrect approach. This demonstrates a failure to uphold fiduciary responsibilities and a disregard for regulatory compliance. By not reporting the issue, the GBA allows a potential problem to persist, which could have significant negative consequences for the plan and its participants, and could also lead to regulatory penalties for the organization. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves understanding one's fiduciary duties, recognizing potential conflicts of interest, and knowing the established procedures for reporting and addressing discrepancies. When faced with such a situation, the immediate step should be to consult internal policies, report to the designated compliance or legal department, and refrain from any action that could be perceived as self-serving or a breach of confidentiality.